Okay, let's unpack this. The world of finance, well, it can feel incredibly complex, right?
Absolutely.
Just full of strategies, transactions that seem completely opaque if you're not, on the inside.
Hmm.
You hear about things like replicating expert traders, and on the surface, that sounds appealing, maybe like a smart shortcut, potentially boost returns.
Sure, that's the pitch sometimes.
But the stack of sources you shared with us, well, they reveal a much, much darker side to how these seemingly simple strategies can be exploited.
Yeah, it's a fascinating example, really, how tools designed for one thing, potentially legitimate investing, can be twisted into these sophisticated mechanisms for, well, financial crime.
Hmm.
It really highlights.
And our mission really is to cut through the complexity. We want to understand what mirror trading looks like when it's used, criminally, identify the critical red flags.
Yes.
We'll look at a major real-world case billions moved this way, see how the financial world's trying to fight back, and connect it all to the broader landscape of financial crime. The goal is to give you a clear picture without getting lost in the weeds.
Sounds good. So let's start where your sources do with that initial concept. Beer trading. It's often presented as a way for investors to automatically replicate the trades of some proven expert, a guru figure perhaps.
Right.
Online platforms often facilitate this, allowing your account to basically buy or sell whenever the expert does.
Right. Okay, that's the shiny public-facing idea, the marketing spin. But the core focus of these sources, it shifts really quickly, doesn't it?
It does, sharply.
They explain that while this concept exists, mirror trading is actually highly vulnerable. And it's widely used as a major financial crime tactic. It's not about following a trading guru at all.
No, not in this context. It's about covertly moving money.
Okay.
Precisely. The criminal mechanics, as laid out in the material you gave us, are built on coordination. It involves two or more linked parties executing corresponding transactions.
Give funding how?
Well, a buy order and a sell order for the same or very similar financial instrument, often at the same price, same quantity, but critically happening simultaneously or very nearly simultaneously in different jurisdictions or markets.
Okay, so picture this. One party, let's say linked to a criminal network, buys a specific bond in, say, London,
Right.
while another party linked to the same network simultaneously sells that exact same bond, same amount, same price, maybe in Moscow or another financial center.
Exactly that. It's perfectly matched activity happening across borders.
Wow.
Yes, and the crucial point from the sources is that these aren't genuine market trades at all. They are entirely prearranged and effectively circular,
Circular.
meaning they generate no real market risk, no profit or loss based on actual price movements in the market.
Yeah. Okay, so if they aren't trying to make money from the actual trading, what's the underlying criminal purpose then? What are they actually doing?
They're moving money.
Yeah.
Moving it across borders while completely disguising its source and its ownership. The sources are really clear on this. It's a common money laundering tactic within capital markets.
Ah.
The trades create this veneer of legitimate investment activity that masks the true purpose, which is simply the transfer of illicit value.
Ah, turning dirty money into what looks like clean trading profits or capital transfers, that's incredibly deceptive.
It is.
So for financial institutions, the ones tasked with spotting this, what are the telltale signs, the key red flags the sources highlight? What should compliance teams, be looking for?
Well, the material points to several critical indicators. One is seeing the same client or related parties initiating these corresponding buy and sell orders in different jurisdictions.
Right.
Even if they use different company names, a look behind the curtain might reveal common ownership or control.
So it's about identifying the hidden connection
Sure.
between the parties on both sides of the transaction.
Exactly. That's a big part of it. Another major flag is the pattern itself. Identical trade volumes and instruments executed within very short time intervals.
Like, too perfect.
Pretty much. When you see matched quantities of the same security being traded almost simultaneously across different markets, it just screams coordination, not genuine market-driven activity.
It's almost too neat to be real trading.
It is. There's also often a clear lack of economic rationale or any, logical investment strategy behind the transactions. Why would a client repeatedly engage in paired trades that just net out to zero profit or risk?
Yeah, makes no sense from an investment angle.
There's no financial logic there.
And how are these often structured? You mentioned companies. The sources mention shell companies.
Yes, frequently.
Yeah.
Shell companies or offshore accounts are often layered into the structure. And that's done deliberately to obscure the true beneficial ownership.
Right. Makes it much harder to link the parties.
Much harder. Linking the ones initiating the buy and the sell orders becomes a real challenge.
Okay, so we have linked parties, perfectly matched trades, no economic sense, and hidden ownership.
What about the trading itself? Does
Ah.
it involve risk? Like normal trading?
That's another very important flag. The absence of any currency exposure or market risk.
Okay.
Genuine trading inherently involves risk, right?
Oh.
The price of the asset might change, the exchange rate could move against you. Mirror trades are structured specifically to avoid this risk entirely.
Which proves they aren't speculative.
Exactly. It proves they're prearranged value transfers, not speculative bets.
And then the money or the assets, they somehow make their way back. Is that part of it?
Yes, that's another indicator the sources point to. Funds or securities ultimately returning to the original party or affiliated entities, completing that closed loop.
Uh-huh.
This shows the transaction wasn't a genuine arm's length trade, but really just a mechanism to move value from point A to point B and maybe back to A later, perhaps cleaned up.
The sources really emphasize that identifying these specific signs, these patterns, they're crucial triggers for financial institutions. They need to initiate enhanced monitoring and investigation when they see these things.
There are the breadcrumbs, basically, the
Right.
breadcrumbs that lead investigators towards the criminal activity.
Precisely.
And the sources, they highlight a particularly notable case involved a major European bank, right? That really put this tactic on the map.
That case was, hugely significant. It involved clients of a major bank using mirror trades specifically between London and Moscow.
London and Moscow.
Yes, the sources detail how this mechanism was used to secretly move billions, literally billions of dollars out of Russia.
Billions.
Yeah. And these trades were facilitated through offshore shell companies. They were later definitively identified as a large-scale scheme for money laundering and also sanctions evasion.
Billions moved using this technique. That puts the sheer scale of this deception into terrifying perspective.
Right.
All hidden as what seemingly routine trading activity.
Exactly. Hidden in plain sight, almost.
So what kind of response did that case trigger from regulators? Must have been huge.
Oh, it led to a substantial regulatory crackdown.
Yeah.
Authorities like the UK's Financial Conduct Authority, the FCA, and the U.S. Department of Justice, the DOJ, they imposed significant fines on the bank involved.
Big fines.
Huge fines. And they mandated drastic improvements in their anti-money laundering, their AML controls.
And it wasn't just about penalizing one institution, presumably. It prompted broader action across the globe.
That's right. It wasn't isolated.
What specific steps have regulators taken since then, according to the sources?
Well, the material lists several key actions. Regulators worldwide have definitely increased scrutiny on capital markets transactions that happen, non-face-to-face, like online trading.
Makes sense.
They've imposed stricter rules around beneficial ownership disclosure, trying to make it harder to use those shell companies effectively.
Cutting through the anonymity.
Trying to, yes. They now require more comprehensive trade surveillance and reporting, especially for clients and transactions involving high-risk jurisdictions.
Right.
And they're really pushing for financial institutions to integrate their AML systems with their market abuse monitoring systems, recognizing that these two areas are often linked, especially with tactics like mirror trading. They're not separate problems.
Okay, so for a financial institution listening, what does this mean they must do now in terms of compliance, monitoring, to stand a chance against this kind of sophisticated scheme?
Well, the sources are quite prescriptive here. Institutions need sophisticated transaction surveillance systems. Systems that can spot potentially linked trades happening across maybe different business units, geographical locations, or even different legal entities that are under common control.
So connecting the dots internally.
Yes, they have to implement rigorous Know Your Customer KYC processes and, importantly, enhanced due diligence, particularly for clients who are frequently involved in cross-border trades or using those complex offshore structures.
Really understanding who the person behind the company is, not just the company name.
Absolutely. That's crucial. They must also conduct thorough risk profiling of clients and the types of financial instruments being traded. Certain things are higher risk. And utilizing advanced data analytics, behavioral modeling, that's key now, to identify anomalies, those trading patterns that deviate from what you'd expect as legitimate behavior.
Looking for those weirdly perfect, non-risky matched trades we talked about earlier.
Exactly. Spotting those patterns that just don't make market sense. They also need robust internal processes for escalating suspicious findings and, critically, filing suspicious activity reports, SARs, with the authorities.
Getting the information to the regulator.
Yes. And finally, ensuring that the front office staff, the traders themselves, and the compliance personnel are properly trained to recognize the specific typologies of mirror trading. They're often the first line of defense.
It sounds like it really requires coordination across the entire organization, front office, back office, compliance.
It absolutely does.
Yeah.
Silos are dangerous here.
And the sources make another important point. Mirror trading. It's rarely an isolated event, is it? It usually connects to broader financial crime schemes.
That's vital context, yeah.
Yes.
Mirror trading often serves as a mechanism within larger criminal operations. It's connected to sanctions evasion, for instance, using trades to move money into or out of countries under restrictions.
Getting around the rules.
Exactly. It's linked to corruption and embezzlement, transferring stolen state funds or corporate funds abroad, disguised as legitimate investment outflows.
Making illicitly gained funds look like capital earned from trading.
Precisely. It can also be a channel for terrorist financing, sadly. Moving funds across jurisdictions to support entities through these disguised transactions. And of course, tax evasion, obscuring the true nature or location of gains or losses across borders. The sources really emphasize that mirror trading isn't just, some form of market manipulation. It's a high-risk conduit, primarily used for money laundering and regulatory evasion.
Okay, so pulling back then. What's the big picture threat that mirror trading represents, based on everything we've discussed from these sources you provided?
Well, fundamentally, it's a serious threat to market transparency. It undermines regulatory compliance efforts. And ultimately, it damages the integrity of financial institutions caught up in it or failing to detect it.
Right.
It functions covertly, moving illicit funds and laundering criminal proceeds, often on a massive scale. It effectively weaponizes standard financial tools to exploit the interconnectedness and sometimes the gaps in the global financial system.
It takes something that sounds on the surface like a simple trading strategy and turns it into this sophisticated engine for moving dirty money globally.
Exactly that, a hidden pipeline.
Okay, that gives us a really clear picture, I think, of what mirror trading is in this financial crime context and why it's such a major concern.
It certainly shines a light on one of the more complex and insidious ways criminals exploit the system.
Absolutely. So as we wrap up this deep dive into mirror trading, the key takeaway for you, listening, based on the sources you shared with us, is really this. While it might be framed innocuously, perhaps as a way to replicate expert traders, mirror trading, as implemented by criminals, is a complex financial crime tactic. It uses seemingly legitimate, often risk-free match transactions executed across different jurisdictions to secretly move illicit money and launder criminal proceeds. It specifically exploits vulnerabilities in the global financial system.
And understanding the mechanics of these sophisticated schemes, well, it's absolutely vital in today's interconnected financial landscape. Because the criminals, they're constantly innovating, always looking for the next loophole.
Which brings us to a final provocative thought for you to consider. Building on the insights from this material about the complexity and the constant need for robust systems, given how criminals can take a standard financial tool, like trade replication, and scale it into a global money laundering operation moving billions, what does this relentless evolution of financial crime tactics actually mean for the future? For securing and maintaining transparency in our financial markets? Is technology the ultimate answer for detection and prevention? Or perhaps does the very same technology simultaneously create new, even harder to spot vulnerabilities for criminals to exploit?
That's a crucial question.
Yeah.
A real challenge for anyone involved in, or frankly, just observing the financial world today.
Indeed it is. And that's our deep dive into mirror trading, made possible entirely by the source material you shared with us. Thank you for bringing this fascinating and actually incredibly important topic to our attention.